Good morning, everyone. Am I audible? Good morning, everyone. Welcome to Office Adda 24/7. My name is Niharika Valia Bhatnagar, and I am with you with the era of ABFM. So, today we are going to talk about discounted cash flow valuation. This involves a time value of money as well. How does it involve time value of money, everyone? It involves the area of time value of money because pata hai, what happens is if I say that work for I am working on a particular course, I'm working on a particular project on which I'll be receiving money over the period of time, not today, not tomorrow, but over the period of time, I'm going to receive some money. So when I'm going to receive some money over the period of time, I need to know the discounted value of the same. Now, why do I need the discounted value? Because without the discounted value, how will I find? I say that after 3 years I'm getting 10,000. What is the value of that 10,000 today has to be known to me, na? Isn't it? That is under discounted cash flow valuation. Under this, they say, acha, basic concepts that we did in terms of JIB. Yeah? We did this in terms of JIB where we did something like in terms of capital budgeting. Uh, okay. Do you remember? We used to say that if I have to get some money in future, that is based upon P 1 plus R raised to power N. What does this mean? When we are trying to find a future value, we are compounding, we multiply, है ना? We move on. Now in this case, we are not finding what we are getting in future. We know that every single year, 1 year, 2 year, three, there's a certain amount coming up. That means we know the future value. How will you find the present then? How will you be able to find the present then? We can find the present by coming back. That is what they call as discounting. ठीक है ना? That is what we call as discounting. So in this case, what we call in this area is discounting is basically coming back to the present. So in this case, can we say if I look at this, we don't know the present value. Discounted cash flow means we are trying to find the present value. How do we find the present value? It is future value divided by 1 plus R raised to power n. This is the formula that we are using, everyone. Done? So based upon this formula, we work accordingly. Let's move on and talk about the next point there. Acha, based upon this comes the first question. Capital budgeting deals with long-term, short-term decisions, both A and B, neither A nor B. Go ahead and answer, everyone. And if you like this session, please go ahead and share it. And at the same time, don't forget to subscribe our channel. Okay, now let's look at the answer then. When we talk about capital budgeting, it doesn't talk about present situation. I'm talking about 1 year down the line, 2 years, 3 years, 4 years. So in this case, it's actually a long-term decision, not a short-term one. So in this case, the correct answer is A, the long-term decisions. Next point, the internal rate of return criterion for project acceptance under theoretically infinite funds. Accept all projects which have IRR equal to cost of capital, IRR greater than cost of capital, IRR less than cost of capital, or none. What would be the point that you will be taking up? In terms of IRR, it is that situation where NPV is equal to 0. That's the formula for IRR. Okay. And what would be the answer according to this? See, internal rate of return is basically the return that we expect. And when we talk about the area of Cost of capital, this is the amount that they are promising. If our expectation is more, right, then we won't accept it. I won't accept something which is, in terms of what they are giving me is less and what I want is more. Then I'll be disappointed with them and I'll be like, no, I don't want to give money to you at all. I will give money to anybody only if the IRR, the internal rate of return, you will do this when your IRR is greater than the cost of capital. Okay? In this case, the correct answer would be IRR greater than the cost of capital. When we are giving more rather than what we were expecting. A project is accepted when NPV is greater than 0, IRR will be greater than cost of capital, profitability index will be greater than unity or any of the above. There are three different methods when we talk about discounted cash flow. Under discounted, we have three methods. First is NPV, net present value. Second is IRR. Third is profitability index. All these are using it. Along with this is one more, that is discounted payback. Under NPV, we find the values of tomorrow. What would be the value today? So we are eliminating the interest portion, getting the value today. Then in terms of IRR, we have to find what they can provide us. IRR. Profitability index says write your total initial inflows. You take up all the inflows which are discounted. Discounted inflows divided by your initial investment. If this is greater than 1, go ahead and accept. If it is less than 1, just reject it. Okay? This is if it is greater than 1. That means if you are putting 1 rupee and getting 1 rupee back, it's not worth it. If you get more than 1 rupee, then it's worth it. So in profitability index, it comes out to be true. As already told, IRR will be greater than the cost of capital, then we'll accept. NPV has to be positive. It should be more than 0. In terms of 0, it would be like if I invest 10 rupees and I get 10 rupees. It's not worth it. It's better that if I invest 10, I get 30, I get 20, I get more than that. So in this case, the project is accepted when any of the above things can happen. Next point, everyone. Which of the following statements are false? Oh, I'm sorry. Just adding up the options for you. Cash flows and accounting profit are the same. Cash flows are profit before depreciation and after tax. Net profit value method is based upon cash flows. Average rate of return is the method on based upon cash flows. Which one is false? Is cash flows and accounting profit same? I would not really say that. But let's see. Cash flows are profit before depreciation but after tax. Net present value method is based upon cash flows. Such as this one's correct in any case. Okay, NPV is based upon the cash that we receive. Average rate of return method is based upon the cash flows. It is based upon that. But pata hai, whatever your net profit would be, you will add back depreciation because it's a non-cash expense. You will add back all the non-cash expenses. What you will get is your cash profit. That is your cash flows. So everything is done as per the cash flows. And so if you like this particular session, then please go ahead and like it as well. Then comes the next point, that is average rate of return method is based on cash flows. Okay, hold on. No, but A is also wrong. Both of these are wrong then. ARR is based upon cash flows. ARR is actually based upon our profit divided by our initial investment. This is normally calculated in percentage. So I'll say that both of these are wrong. So both A and D will go wrong. In this case, both A and D are wrong. First is not correct because accounting profit is not the same. As I told you, you will have to adjust all the net non-cash things because you can include only and only cash inflows. While in terms of net profit, many non-cash things are also added because it is on accrual basis, first of all. Many organizations work upon accrual basis as well. And secondly, when we talk about this area, we also face one more thing, that is, other than the accrual area, we also include those expenses which we are not paying, but we still make it as an expense. Acha, what might a DCF valuation be most appropriate? When valuing a stable, mature company with predictable cash flows, when valuing the startup with certain uncertain future cash flows, when valuing the company solely based upon book value, when valuing a company based on its market share. Where is discounted cash flow appropriate? Matlab, one of the basic areas where I can see DCF can work is when we have future cash flows defined. We are not getting money today. We might be getting the money tomorrow, day after tomorrow, after a certain period of time. It's like 1, 2, 3, 4. We're looking at the future area when we'll be receiving the money. Not today, but we'll be receiving it tomorrow. And it has to be a very stable, mature, and company predictable. Achha, this is also one of the most important areas. That is, it should be reliable. Think about it. I give you approximately 10 can come. No, let's make it 20. No, let's make it 30. What will you do? You cannot apply the model. The moment you will finish up your discounting, then you will be facing a problem. So it's better that we do not use this area at all. It has to have a certain cash flow, not uncertain cash flows. In DCF valuation, what is terminal value? Terminal means what you get by the end. The value of the company at the end of the projection period, the value of the company at the beginning of projection period, the value of the company assets and value of company liabilities. Terminal means end. So in this case, what will it be? It is basically the value at the end of the projection period. That would be the answer. Which of the following method takes into account the time value of money? Payback, ARR, NPV, or all of the above? Okay, let me tell you, there are certain things which are called traditional. Under traditional methods, we have payback and ARR. They do not use, or they don't even agree upon time value of money. That is why they are called traditional methods. Under the modern methods, which includes NPV, IRR, discounted payback, profitability index, that is considering time value of money. That means it involves DCF, discounted cash flows. Done, everyone? Here it is net present value. Evaluation of capital budgeting proposals is based on cash flows because cash flows are easy to calculate. Cash flows are suggested by SEBI. Cash is more important than profit or none of the above. I won't say cash flows are easy to calculate. And even SEBI doesn't say that way. SEBI doesn't talk about the capital budgeting. That's an internal decision of the organization. So I would say both of these are definitely wrong. So what's right then? Cash is more important than profit. That is true. The cash that you are receiving is very much important and it is more important than your profit. Okay, next question, everyone. What is the primary objective of discounted cash flow valuation? What's the first thing why they are doing it? To estimate the market value of the company, to determine the intrinsic value of an investment, to analyze the liquidity, or to calculate the ROI of a project. What would it be? See, DCF is important. Till the time you don't find the realistic values of your organization, things won't work out. When we talk about discounted cash flow valuation, it is talking about the valuation or realization of funds, whatever we'll realize over the period of time. The estimate the market value of the company, it is not based upon historical performance. It is based upon what we'll receive in future. You know, ROI is also something which I'll say this is also a traditional method. Return on investment is also a traditional method. So whatever has future would be conducted here. Nothing of the past would be included in this. Only the ones which is related to the future will be added to it. Done, everyone? Okay. Going good, Ravi sir? Let's take up the next question then. Let's take up the next question now. Here it is. What is the limitation of DCF, everyone? It is based solely on historical data? No. It does not consider the time value of money. It considers. Good morning, Ashish sir. It considers it. It relies on the accurate future cash flows projections. It may be sensitive to changes in discount rate. I would say it relies on something which is certain. Okay? It may be sensitive to discount rate changes as well. When we talk about the discount rate changes, first of all, always remember cash flows should be something which we are at least sure about. We are looking forward to this is the amount that we can have. And when we talk about the sensitivity, if your discount rating factor is 10%, then the value will come out to be different. At 12%, it will vary. At 14%, it will vary further. So it will keep on changing. Acha, the next question. The last question for the day. Depreciation is incorporated in the cash flows because it is unavoidable cost. It is a cash flow. It is not a cash flow. It is a non-cash expense. So in this case, what would be the answer? It would be, it reduces the tax liability. In actual, what happens is, whatever your profit is before depreciation, you say कि नहीं, the value of the asset is also declining, so I'll write it as depreciation. That will give you profit after tax, profit after depreciation, and whatever your depreciation would be, then you remove tax out of it. It comes after you're paying the depreciation. So this is where we call it profit after tax, which is basically relieved because of depreciation. So in this case, it reduces the tax liability. Done, everyone. That's it for the day, everyone. The next class, we'll be covering the next portion. Till then, let me show you our website. You need to go on to the area of www.adda247.com. Go on to the area of JIB and CIB. Then go on to the area of CIB November attempt and These are the batches which have already started. You can review the batches of Sankalp batch which are already going on. Along with that, our double validity is going on our Mahapack as well. Currently, it is available at 80% discount. That means mock test, 970 video lectures, ebooks, recorded videos of the previous batches plus the current batches, plus both English medium and bilingual would be opened up for you. Ebooks are available. A lot of MCQs for practice are available. Live classes are available for you. All the revision batch will also be included in this. So we are including a lot of these things in your this particular area of the Mahapack. So kindly review it on our website, on our app for further details. So go ahead and check it out. To buy this, you can use the code exam80 to get 80% discount, and using the app you can get another 1% as well. Thank you, Ashish sir. Thank you everyone. We'll be meeting the next class. If you like this particular session, please go ahead and like it and share it among your peers, and we'll be meeting in